A decade from now, a great many people will say the same thing they always say after a major wealth window closes. They will say they knew something big was happening. They will say the signs were there. They will say the technology was obvious, the spending was obvious, the concentration was obvious, the hesitation in the crowd was obvious, and the chance to buy before certainty arrived was visible in hindsight. What they usually mean is that the story became easy only after the money had already been made. I have lived long enough to know that the market rarely pays people for what is obvious. It pays them for what is true before it becomes comfortable. That distinction matters because I believe we are living through one of those rare stretches when the future is not merely changing, it is repricing itself in public. And when that happens, a decade of ordinary returns can get compressed into a handful of years for the people who position themselves correctly before the broader crowd decides it finally feels safe. That is why I want to talk about what I think may be the last big wealth opportunity for the next decade, perhaps longer. Not because civilization is ending, not because markets are ending, not because everything after this will be bad. I mean something narrower and more important. The conditions that create outsized, life-changing public market wealth tend to cluster early, then narrow, then become crowded, and finally get normalized into lower return participation after the easy asymmetry is gone. That sequence has happened before. Railroads did not create the same fortunes for investors in the fully mature phase that they created in the formative phase. The internet did not create the same public market asymmetry after broad adoption that it created when the architecture was still being built. Mobile computing, cloud infrastructure, platform economics, and semiconductor leverage all looked one way before certainty and another way after certainty. The crowd likes to buy certainty. Wealth is usually built by buying before certainty. If I were 25 again, or 35, or 50 and still building, I would want to understand 5 forces that are colliding right now. The first is that we are still near the front edge of several exponential curves at the same time. That matters a great deal. Usually one big technological wave is enough to create meaningful winners. What makes the current moment unusual is that several major systems are maturing into commercial dominance together. Artificial intelligence is not just a software headline anymore. It is becoming an operating layer inside labor design, customer service, logistics, coding, security, healthcare, search, and enterprise decision making. Once a technology begins moving from demonstration to margin expansion, the market stops paying for the dream and starts paying for the earnings. That is where serious money often gets made. Automation is traveling beside it. When companies discover they can increase output without increasing labor at the same rate, profits can move faster than the average observer expects. Public markets do not need every company to become magical. They only need a few very large firms to discover that a new productivity layer can widen margins meaningfully. Then there is energy. The world is trying to digitize, electrify, automate, defend, and compute at the same time. That requires power. Not in theory, in hard physical terms. Grids have to be rebuilt. Transmission has to be expanded. Data centers have to be powered. Hardware has to be cooled. Storage, generation, and infrastructure are no longer side stories. They are becoming central economic stories. Biotech and longevity sit in the background more quietly, but I do not think quiet means small. Better tools for diagnosis, treatment, gene-level intervention, drug design, and later life health have enormous economic value. The crowd often misses this because the public imagination usually gets captured by whatever is loudest right now, but medicine has a long history of rewarding the people who arrive before the headlines become sentimental. Defense, space, and cybersecurity are also no longer niche curiosities. A world full of geopolitical strain does not spend less on resilience. It spends more satellites, surveillance, software defense, autonomous systems, secure infrastructure, and military. Adjacent supply chains are all becoming economically relevant in a way markets cannot ignore forever. When I step back and look at all of that together, I do not see one trend. I see multiple exponential curves crossing into monetization at the same time. That is not normal. And public market history suggests that the largest percentage gains usually happen during the early adoption phase, before broad awareness, before valuation saturation, and before every institution has fully positioned itself. Once the whole world agrees on where the growth is, the best asymmetry is usually gone. That is why I think so many investors are underestimating the timing element. They imagine they can wait for clarity, then buy the winners, but clarity usually arrives after the re-rating. The second force is concentration. This is a word most investors hear and then fail to respect. They know a handful of large technology stocks have become dominant. They know the big names: Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, Tesla. They know these companies have become huge, but they do not fully absorb what it means when a small group of firms comes to represent roughly a third of the market's value. That concentration is not merely a trivia fact. It is telling you where the market believes the growth is, and periods of extreme concentration often carry a message. A broad market may look healthy on the surface while the real performance engine is narrow underneath. That has two implications. First, broad index returns are increasingly being driven by a small number of extraordinary companies. Second, if you miss the dominant beneficiaries of the current wave, you may own the market and still fail to participate in the strongest part of what is happening. This is why I no longer believe that simple diversification by itself is always enough when the economy enters a period of concentrated technological payoff. Diversification is useful. Over-diversification into mediocrity is not. There are long stretches in history when broad exposure is entirely adequate because growth is wide and leadership rotates gently. This does not feel like one of those stretches. This feels like a stretch where leadership is narrow, where the biggest winners are likely to matter disproportionately, and where owning a little of everything may produce safety but not necessarily exceptional results. I am not saying people should become reckless and abandon a sensible broad foundation. I would never say that. But I do believe this environment rewards investors who understand that markets are becoming more lopsided, not less. Many individual stocks underperform the index over long periods. That fact alone should make a person humble, but it should also make him curious, because it means the index is often carried by a relatively small set of outsized winners. If those winners are being forged in this period, and if the next few years are when they are still translating technological dominance into earnings dominance, then timing matters immensely. The third force is demographics. This is the most boring of the 5 drivers, which is exactly why I pay attention to it. Boring forces often carry the largest long-term consequences because they operate quietly while the crowd stays entertained elsewhere. For many decades, markets enjoyed broad tailwinds from expanding workforces, rising productivity, deepening globalization, and a demographic structure more favorable to growth. Younger populations consume differently. They borrow differently, they take risk differently, they build households differently, they support labor, force expansion, and capital formation in ways that are not always obvious quarter to quarter, but matter a great deal over 10 and 20 years. That tailwind is weakening. Aging populations do not guarantee poor market returns, but they do tend to reduce the magnitude of broad-based economic tailwinds that investors got used to in earlier decades. Slower labor, forced growth, higher dependency ratios, and altered savings and consumption behavior can all reduce the natural speed of GDP growth. That matters because broad market returns over very long periods are anchored to broad economic growth and corporate earning power. If demographic headwinds make broad growth harder to achieve, then the market may become even more dependent on a smaller set of companies capable of outrunning the broader economy through productivity, technological leverage, automation, or global dominance. That reinforces the concentration point. It means the next decade may not reward passive mediocrity the way some earlier decades did. It may reward the businesses that can keep compounding even as the broader backdrop becomes less generous. And here is the really important implication. If the next 10 or 15 years are marked by weaker demographic tailwinds, then the current moment may be one of the last stretches where a patient investor can still buy into the early commercial phase of major new growth engines before the whole landscape becomes more mature, slower, and more institutionally controlled, that does not mean there will be no future opportunities. It means the window for truly outsized public market upside may be narrower than people think. The fourth force is monetary. This one matters because a great many investors built their worldview during a period of easy money. When rates were near zero and capital was cheap, almost everything could work for a while. Valuations expanded, growth companies got rewarded for stories, duration risk felt less painful. Assets soared, partly because the discount rate behind everything had been flattened. It created an era in which ownership alone often felt like genius. That era changed, maybe not forever in exactly the same way, but enough to matter. Now, I know the argument people make. They say a new Fed chair may arrive, rates may come down, monetary policy may ease, there may still be tailwinds. Fine, that is possible. I am not ideological about it, but I also look at the world as it is. Global conflict is elevated. Fiscal needs are huge. Debt is large. Inflation proved more stubborn than policymakers wished. Long-term rates may stay higher for longer than the crowd would prefer. And even if short-term rates move down, we may not return to the kind of endless, almost frictionless, easy money era that conditioned so many investors in the 2010s and early 2020s. That matters because easy money flatters almost everything. Tighter or more uncertain money forces markets to discriminate. When money is no longer free, real profitability matters more, real balance sheet strength matters more. Real demand matters more, real infrastructure matters more, and companies that are merely exciting without durable economics begin to look much less appealing. This is part of why I think the current wealth window is special. If capital remains more selective, the winners from these exponential curves will likely be companies with real earnings power, real infrastructure, leverage, real product market fit, and real economic consequence. In other words, the very phase where public investors can still buy them before they become fully mature giants may be one of the most valuable parts of the cycle. Later, once markets have fully priced the certainty, the returns usually compress. That is how it works. The early stage produces asymmetric upside. The mature stage produces admiration headlines and lower future returns. That is not pessimism. It is just the normal life cycle of public market opportunity. The fifth force is sentiment. This one is my favorite because it is the most human. Extreme wealth is usually built in periods where disbelief still lingers. That does not mean the headlines are negative every day. It means the broad public still has enough hesitation, that prices have not fully re-rated to reflect universal confidence. We are still in that sort of environment. Retail investors are cautious. The media mood is fragile. Many people are still waiting for clarity. They say they want confirmation. They want the economy to look cleaner. They want rate paths to feel easier. They want geopolitics quieter. They want the market to tell them it is safe. What they do not understand is that by the time investing feels emotionally safe, the prices usually already reflect that safety. The best returns tend to happen before the final reassurance arrives. This is not only true in theory. It is one of the oldest patterns in markets. The public waits for uncertainty to disappear. The market moves while uncertainty is still visible. Then, once prices are much higher and the narrative is comfortable, the hesitant crowd finally enters. They do not buy the asymmetry. They buy the validation. Validation is expensive. This is why I pay close attention when the crowd is aware of a theme but not yet fully participating in it. Awareness without full commitment can be the sweet spot. People have heard the story, they understand some of the pieces, they suspect there is opportunity, but they are still nervous enough to delay. That delay is where disciplined capital often finds its best odds. Now, I want to be careful here. I am not saying everyone should start chasing themes wildly. I am not telling people to throw away prudence. I am not suggesting that the answer to a rare opportunity is emotional speculation. What I am saying is narrower and more useful. When several exponential technologies are entering commercial payoff, when returns are increasingly concentrated in a few dominant beneficiaries, when demographic headwinds may reduce future broad-based growth, when the easy money era is less likely to rescue every weak idea, and when public sentiment still lags full conviction. That combination often creates a particularly fertile environment for patient wealth building, not reckless wealth building, patient wealth building. That is an important distinction. The crowd hears opportunity and immediately thinks speed. I hear opportunity and think compounding. If I wanted to use public vehicles to express this view, I would begin exactly where I have always believed sensible investors should begin. I would start with a broad foundation, some type of large, low-cost, broad market fund, the SP 500, a total U.S. market fund, perhaps a total world fund, depending on the investor's philosophy. You need a foundation because foundations let you survive being wrong about some details without losing the whole structure. Foundations give you exposure to the broad productive engine of capitalism. They keep you in the game. But if I believed as I do that this period may offer a lopsided payoff to the main beneficiaries of technology and infrastructure concentration, then I would add a deliberate growth sleeve on top of that foundation. The first expression of that view would be broad technology and innovation exposure, something like QQQ or QQM. I am not speaking about them as magical products. I am speaking about the role they play. They give you exposure to the NASDAQ 100, which includes many of the companies that are directly enabling or monetizing the current wave of AI, software, cloud infrastructure, semiconductors, digital advertising, and platform economics. Microsoft, Nvidia, Alphabet, Meta, Amazon. Those kinds of names matter because they are not just participants. They are often the toll roads through which the new economic activity runs. Over the last decade, funds of that type have significantly outperformed the broad market because technology leadership has been real. Not imagined, of course, the future will not look exactly like the last decade. It never does. But I do not need it to look exactly the same to see that the core economic leverage of these businesses remains enormous. While the next wave of monetization is still unfolding, the second sleeve, if I wanted more explicit exposure to the AI build-out itself, would be something more targeted. The kind of fund that does not only own the obvious mega cap names, but also owns a wider set of infrastructure, software, semiconductor, and enabling businesses that may benefit from AI adoption, even if they are not household names in the reference material. ARTY fills that role. That makes sense to me as a tactical growth sleeve, provided the investor understands what he is owning and keeps the position sized in a way that serves the larger portfolio rather than dominating it. This matters because specialized funds carry more volatility and narrative risk. They can do very well when the theme is working, and they can disappoint sharply when sentiment turns. That is why I would never confuse a targeted sleeve with a foundation. It is an expression, not the whole portfolio. The third sleeve, if I wanted the most direct exposure to the physical hardware backbone of the AI and compute build-out, would be semiconductors. That is where something like SMH enters the conversation. Semiconductors fascinate me because every modern digital ambition eventually runs into physical reality. You can dream about AI all day. At some point, it has to be trained on hardware, it has to run on hardware, it has to live in data centers, it has to move through chips, fabrication, lithography, advanced packaging, memory, and the long, hard physical chain that supports computational scale. That is why semiconductor exposure can be so powerful. It is not because chips are fashionable. It is because chips are foundational. And when something is foundational during an adoption wave, it often participates in the economics more deeply than casual observers appreciate. Now, you will notice something about the way I am framing these vehicles. I am not treating them like lottery tickets. I am treating them like specific expressions of a broader economic thesis. That is how adults allocate capital. They do not merely ask what is hot. They ask what role this asset plays in the portfolio, what thesis it expresses, what could go wrong, how much concentration is appropriate, and whether the structure still works if they are partly wrong. This is why I always return to sizing. A broad market foundation should be the largest piece for most people. A broad technology growth sleeve can be meaningful, but should not become blind worship. A more targeted AI or semiconductor sleeve can be useful, but only if the investor remains aware that specialization cuts both ways. You can be very right about the long-term direction and still get shaken by short-term volatility if the position is too large for your temperament. And temperament matters. That is one of the great Buffett lessons people keep hearing and rarely internalizing. The market is not only a test of analysis, it is a test of behavior. If you own the right thing in the wrong size, you may still sabotage yourself. So when I say this may be the last big wealth window for a decade or longer, I do not mean go all in. I mean get in intelligently, build the base, add the growth layer, add the targeted layer if you truly understand the thesis. Then give the machine time, because that is the other mistake people make. They hear about a rare opportunity and think speed again. They want dramatic returns on dramatic timelines. They keep checking, they keep trading, they keep trying to outsmart the very compounding they claim to want. Number the opportunity here as I see it is not to speculate. It is to buy into real productive trends before certainty becomes fully priced, and then let those assets do what compounding assets do and you stop interrupting them. That takes patience. And patience is emotionally expensive right now. Everywhere you look, the culture is training people out of long-term attention. It trains them to expect immediate feedback, constant novelty, emotional reinforcement, and daily explanation. Markets do not owe anyone that kind of comfort. Markets pay the people who can sit with intelligent discomfort longer than the crowd. That is why the current sentiment backdrop matters so much. So many people are still waiting for the emotional green light. They want to be told that rates are definitively down, that the economy is definitively safe, that AI spending is definitively sustainable, that geopolitical risks are definitively manageable, that the market can be entered without psychological cost. That green light never arrives in a form the crowd finds satisfying. The market moves first. The explanations come later. That is why I like this window. Not because it is easy, because it is still uncomfortable enough that the crowd has not fully crushed the asymmetry. I want to say something else that matters deeply. This may indeed be a great wealth window, but it is not guaranteed to reward laziness. A person cannot simply buy the most popular acronym and expect life-changing results. Even broad winners go through drawdowns. Even semiconductors can get overextended. Even AI beneficiaries can face periods where the market suddenly worries about spending cycles, competition, regulation, geopolitics, or valuations. This is not a promise of a straight line. It is a statement about the likely distribution of opportunity. The people who win will probably be the people who combine conviction with structure. They will own broad foundations. They will own the principal beneficiaries of the new build. Out they will keep enough liquidity to avoid stupid selling. They will size targeted exposure intelligently. They will let the thesis mature rather than demanding instant proof. They will survive being early. That last one matters. The crowd loves to say, timing is everything. That is too broad. Timing matters. But for most serious wealth building, survival matters more. If you are a little early and remain solvent, structured, and patient, you can still do very well. If you are exactly right about the thesis but emotionally weak, over-leveraged, or over-concentrated, you can still ruin yourself. So I would rather be sensibly early than theatrically precise. That has always been my preference, and I think it fits this moment perfectly, because the big money from these waves will not be made by the people who buy after the final magazine cover. It will be made by the people who see that the economic base is still being laid. We are still building AI infrastructure. We are still building power systems to support computation and electrification. We are still sorting out which platforms will capture the margin expansion. We are still seeing defense, cyber, and space move from peripheral budget items toward central strategic spending lines. We are still in the stage where a few firms may become much larger than the crowd comfortably imagines, because the crowd is comparing them to old frameworks instead of the new economic map. That is where the asymmetry lives. Now, I should also say something about what happens after the window. because people hear phrases like last big opportunity and imagine a cliff. That is not what I mean. The world will still produce returns later. Good businesses will still grow. Broad markets will still compound over long periods. People will still build wealth. What changes is the ease of buying obvious future winners before they are universally obvious. What changes is the degree to which a patient public investor can still capture an oversized slice of an adoption wave before institutions, analysts, pension flows, thematic products, and full narrative maturity flatten the return profile. In simpler language, the best part of the curve is usually early, later can still be good. Early is where it is often extraordinary. That is why I think the next 5 to 10 years are likely to matter disproportionately. Decisions made now may echo for much longer than the average investor expects. A person who builds intelligently into this phase may spend the following decade simply defending and compounding what was set in motion here. A person who waits for everyone else to approve may still do fine eventually, but likely from a much more expensive starting point and with much less upside embedded in the purchase. That is not theory to me. It is one of the oldest patterns in the market. The future pays most richly before it becomes consensus. Consensus is where safety feels better and returns often get thinner. So what would I do if I were building now? I would keep the broad market core because the core keeps me in the game even when some details go wrong. I would add meaningful exposure to the major growth beneficiaries because concentration tells me where the economic leverage is currently strongest. I would consider a targeted AI infrastructure sleeve because the build-out is still earlier than the public narrative suggests. I would consider semiconductor exposure because hardware tends to matter more, not less, when computation becomes foundational. I would keep enough cash or short-duration safety to avoid forced selling and to take advantage of fear when it arrives. Then I would let time do the work the crowd keeps trying to do emotionally. This is where the title of the original piece becomes useful. Last big wealth opportunity for a decade or longer. Taken literally, it sounds dramatic. Taken properly, it means this may be one of the last periods in which patient public investors can still buy into multiple world-changing economic transitions before the full weight of certainty. Institutional capital, slower demographics, and more mature valuations compress the reward for showing up. That is a serious statement. And I think it deserves a serious response, not fear, not hype, serious capital allocation, because one day, perhaps not too far from now, the same people who are still waiting will say they always knew AI mattered. They always knew chips mattered. They always knew power infrastructure mattered. They always knew a few giant firms were carrying the market. They always knew demographics would make future broad growth harder. They always knew easy money conditions were changing. They always knew that clarity arrives after repricing. Yes, they will know it then. But the market tends to pay for knowing it now. That is the difference. And if you ask me what separates the people who become very rich from the people who remain permanent observers of wealth, that is often the difference there too. Not raw intelligence, not secret information, willingness to act before comfort, willingness to own before certainty, willingness to compound without applause, willingness to let a sound structure work while the crowd is still negotiating with its own hesitation. I have always thought that was one of the most useful forms of courage in finance, not recklessness, not ego, just the quiet willingness to allocate capital toward what is becoming true before it becomes socially easy. That is what this window looks like to me. And if I am right, then a decade from now, the people who use this period well will not look lucky. They will look obvious. That is how every great wealth window appears after it closes. While it is open, it feels uncertain. Afterward, it feels inevitable. The market pays only for the first experience, never for the second.